It was just a few quick questions with respect to personal finance. So, how do you choose a good fund or a good manager, or is it the same? So, choosing a manager or a fund is exactly the same. How do we go about it?
No, so in my view, at least, I think there are many fund managers who do multiple funds. So basically each individual who's investing into mutual, then you choose the funds that fit those parameters for you. Now, amongst these funds, then you go back to the fund managers of each of these funds and you see which fund manager you want. Methods and multiple funds, both qualitative and quantitative, to look at his track record, to look at his communications, to look at his framework, his research framework, how does he go about selecting stocks, or the mandate of the fund. So, you need to do some of these things. Obviously, we have financial intermediaries like which, can help you.
But then the information becomes a bit too overwhelming and it becomes a little distorted, quite a bit distorted. A personal interest involved with the information being rolled out.
Correct.
So when I'm looking at choosing a manager or a fund, let's say I'll talk about it from a very, very retail level.
Mm-hmm.
So in that case, we are making choices with respect to mutual funds.
Right.
When we are looking at HNIs or rather even UHNIs, ultra HNIs, in that case, we are looking at it more from a PMS sort of a view.
Yes.
So how do you see the difference, or how do we see the choice of fund at a retail level first?
Correct. So I think for most of the retail investors who have very little financial literacy or
Right.
very little time,
Correct.
to evaluate these things, for them I think ETFs and large mutual funds, these are the good options. So
Right.
ETFs, because ETFs are passive products and you by default it's only the large companies that you are buying there because only the large ones make it to the index. And large mutual funds because some of these fund managers have been managing money for 20-30 years,
Right.
established track record. Schemes have a very, very long running track record, so you are in safe hands and you're not going to go bust tomorrow if you invest
Right.
in certain products. So I think for majority of the retail investors, this is the two products which I would recommend because they just don't have the literacy or the
So here you're choosing the fund.
the fund, because you're choosing the fund because its a track record is long enough. You're choosing the fund because it's investing into large companies, not taking much risk for you, and you're choosing an ETF again for the same reasons, large companies.
So we decide the mandate or the strategy. I want a large cap or mid cap based on my risk return
based on
appetite.
risk return appetite,
Right.
and also your time horizon. So
Correct.
I think the history of the world will tell you that small and mid caps give you higher return than large caps if you are able to invest for more than 10 years.
Okay.
But over 1 year, 2 year, 3 years, the story can be completely different.
Absolutely.
Right. So you have to understand risk appetite also,
And
but
especially
time
with the
horizon.
turbulence we have seen.
Especially with the turbulence. So you have to understand that when you buy equity, you buy volatility, and then when that volatility comes, you don't be perturbed by it. You
Right.
be prepared for it. That this is what I bought into. See, fixed income gives you lower return because it doesn't give you volatility, right? Equity, when you buy volatility, and therefore be prepared for it. And if you are able to hold for 10 years, then buy into more smaller and mid-cap companies because over a period they will perform very, very well. But in the near term, because these are smaller
Correct.
companies, they can go through some turbulent
So
phases.
that asset allocation between large, mid and small cap would depend on the risk appetite,
Risk appetite
and
of the
the
investor.
time horizon
And
of the
the time
investor.
horizon.
Right, and very well said with respect to, when you buy equity, you buy volatility basically, but in the long term, that volatility kind of
Phases out.
phases out. Absolutely. So when you're looking at an ultra HNI, in that case, you're looking at more of a fund manager than a fund.
Absolutely. So an ultra HNI generally knows what he's getting into. He's financially literate. He has a team which is financially
Correct.
literate. They have family offices. And they know their risk appetite,
And they're diversifying across managers because they're investing across fund
products.
managers and products.
Exactly.
Right.
So PMSs, AIFs, these alternative investment products are very popular with these ultra HNIs.
Right.
And the reason being that they understand the business very, very intricately, they understand the product very intricately, and they then, the repute of the fund manager sort of precedes
Right.
the product, and the fund manager is launching the product, is telling you what to do, they study the research framework.
And it's more specific as compared to the large mutual funds.
Absolutely. There's a very specific mandate
Right.
given to each of these funds and schemes, and these funds and schemes are very specific to their mandate.
Right.
So the ultra HNI is able to decode that as to what he's
Correct.
getting into, right? And because he's financially literate and he spends that kind of time on evaluating these schemes, he basically knows what he's getting into. And that is why these guys are very happy with alternate investment products. But that's not for the retail guy because
Correct.
these products don't come to him, and two, he may not have the time or the literacy to understand.
Right. But so one needs to plan their personal finances and also understand the criterias, constraints, etc. they have, and accordingly choose the product.
Absolutely.
And just not be that me too following
You can't.
the crowd.
You just can't.
Right.
So for someone who has a 10-year time horizon, a mid or small cap product is a great product.
Right.
To invest in. For someone who has a 2-year time horizon, that's probably the worst product to invest.
So one needs to do a lot of homework in terms of that, because at the retail space, I personally see that we do not have so much access to professional wealth managers who exactly guide you from a very portfolio perspective.
Correct.
It's more of compliances and the the buying of mutual fund and the process being taken care of.
Correct.
At a very retail
Actually,
level.
at the retail level, the worst mistake investors make is they look at the 1 year, 3 year, 5 year performance of the fund.
Okay, so I was coming to that question: how to track the performance?
Yeah. So I think the most common error people make here is what we call the endpoint bias.
Endpoint bias.
Endpoint bias. So what happens is, when investors generally want to invest in a product, the first thing they do is they look at the 1 year, 3 year, 5 year, 10 year performance of the product.
Right.
Now the problem there is that all these returns will be good if the fund NAV today is very good.
Okay.
So let's say I am a fund manager whose fund has been going on for 10 years, and as a fund manager I invested only in penny stocks.
Okay. Being able to choose the correct product. Do you think that this variety of options into the fund space today and the ETFs, etc., is it going to create more of a problem, or is it going to be aligning the risk return of their investments?
No, so I think if you look at the Western markets today and compare it to something like an Indian market, we don't have enough variety of products.
Okay.
So there is a good variety of products which have come out of late, but we are still not there where we can actually afford to confuse investors. We are actually giving you more options today. So let me divide the potential investor into 3 parts. So one is a potential investor who has absolutely no financial literacy and absolutely no time to spend on his personal wealth management.
Okay.
So for this guy, the best suited product may be a large cap mutual fund or maybe an ETF.
Okay.
Right? Beyond
small cap, mid cap, if he has a good long term
horizon, maybe yes.
All right.
Maybe yes. But most probably he would go for ETFs.
Because with this inflation, you desperately need to create wealth.
Some wealth, yeah. So yeah, maybe small and mid caps, but then you need to control your behavior. You need to be invested for 10 years.
Yeah.
Which is another thing we'll talk about later probably. But so this is the first kind of investor.
Correct.
The second kind of investor is an investor who has some financial literacy, some time to manage wealth, but he doesn't have a lot of time or a lot of financial understanding.
All right.
So this guy can go about selecting mutual funds, selecting fund schemes, so he can analyze his own risk appetite, he can analyze his own risk aspirations, his own return aspirations, his own time horizon, and he can go about choosing some right products for him in the marketplace. Right. So this guy can basically do the mutual funds more actively. And then the third guy of type of guy is who is extremely financially literate, and he has a lot of time to manage his personal wealth.
Right.
So such guys also can get into direct equities and take a little more risk because they have a little more understanding, and then go that way. So today we have enough products in the marketplace who can address Mr. A, Mr. B, and Mr. C, right? But I don't see that we offer that variety of products that we can actually confuse them, right? If you go to Western markets, you will have unlisted equity space, you will have REITs, you will have structured products, you will have MLDs. Today we don't offer any of this today.
We've just got a couple of REITs, and that too recently listed in the markets, right?
We have very less variety today compared to
just on that note, when you're talking about the investors actually doing their research, because there are a lot of wannabe part-time investors, if I can call them so. So when you're looking at a company, when you're investing that money, how many years of annual reports do you read of one particular company?
If available, 20 years. If not, then 10.
So 10 years is the minimum number of annual reports that you read?
If available, then yes.
So
sometimes companies are newer,
so newer companies would have less number of reports. How many years of worth of con call do you read?
Con calls maybe last 4 years.
4 years of con calls, so approximately 16 con calls.
16 con calls.
So that is the amount of depth and research that goes on.
Absolutely.
And then you meet the management as well, as far as I understand, with the industry and how it works.
We do.
Along with that, what else do you do in terms of?
So we meet peers. We ask questions. So it's called scuttlebutt.
Okay.
So you do a lot of scuttlebutt as well. You meet the peers, you meet the vendors, you meet the customers.
So your channel checks and
channel checks. So because when you do that, you get more information. See, the company will always talk good about itself, be it in an annual report, be it in a con call. It's only when you talk to the peer. See, if a peer admires an industry peer, you know it's doing well.
Okay.
If a vendor says, okay, I get my payment in time and I get very large orders, you know that the company is doing well. If a customer says, I can't do without this vendor, you know the company is
So that's the depth of research that a fund manager brings in.
Has to.
So one needs to, so even when one is investing into a company, then either invest into those blue chips and all, wherein you are kind of confident that an HDFC or a Reliance probably may not ever go wrong,
Correct.
and just buy at a proper price point, or I've seen people doing like an SIP into these kind of companies as well.
They do.
And that too, having a decent understanding of the industries and the companies and all. But otherwise, that's the depth of research that you bring in. And hence, if you are unable to do that because that's not your core job, so you choose pooled investment vehicles like mutual funds, PMSs, etc. Perfect. So, your advice to building wealth for a 20 to 25-year-old individual, and then I'll ask you for a 45-year-old individual.
So, for a 20 to 25-year-old individual, the best advice I can give you is be risk aggressive. Save some money out of your salary or whatever you're doing. Save some money, as much as you can save, and try and invest as much as you can in equities, because you have a long working career ahead of you.
Right.
You don't need the money right now because you're probably not married. You don't have to spend too much. You cannot be a large consumer, right? So you save most of your salary. Start investing. Make your own mistakes. And if you start investing, if you start understanding equities at an early age, by the time you need the money, your corpus hopefully would have become something very, very meaningful. And that you need to save at an early age. And you can't be really, you can spend on some things obviously, but you cannot be frivolous with your lifestyle.
I personally spend a lot on books, and I like to spend on things that I want to spend on rather than that the society dictates me to spend on.
Absolutely. So investing in yourself is the best investment you can do, right? So I know you believe in that, but that's true. So you invest in yourself,
right?
So spend on books, spend on courses, spend on any soft skills that you can get by doing anything. So playing golf, right, teaches you so many things. Play as any other sport, for example, which teaches you a lot of things. So for personality development, brain development, travel. So these expenditures are okay. But if you become frivolous and if you don't save enough and if you don't start building wealth now, you can't retire early then. You'll have to work.
So you've got to spend out of what you're earning and not with the EMIs and all, with your future possible income.
Exactly.
You're not supposed to spend futures income today.
So when you pay EMIs, you're actually discounting future income.
Correct.
So you have to be very, very careful with what you want to do with your future income.
And for a 45-year-old individual then?
So the first step for a 45-year-old individual is to assess what he has today, right? I read in Hindustan Times carried an article where they said 70 to 75% of India's personal wealth today is in real estate. Something around mid-teen is in gold.
Okay.
So if you think about what's left over is 10%.
Right.
And that 10% is all financial assets.
Correct.
I think
bonds, stocks.
Equity was 2 or 3%. Mutual funds is another 2 or 3%. And equity is direct equity and mutual funds is mutual
That's
funds.
why there's so much space that DIIs can occupy.
Exactly.
Right.
So the target market is huge.
Right.
But the fact is that, if an average 45-year-old today will have 70% of his wealth in real estate. So which means in his financial planning, he has to start reducing the weight of real estate in his portfolio.
Or increase the weight of. Because again, real estate becomes a bulky asset.
So if 1 unit is very large. So, so when you have real estate, you have real estate. It will be 70-75%. Right. But then incrementally, your savings should not go into real estate at all. It should go into other financial products so that the weight of those products over time can grow big enough and nullify the real estate.
So that brings me to this conception when you're looking at an Indian investor. There's always a tussle between real estate versus equity.
Right.
And real estate is where we personally see that, there's more wealth to be made in real estate, or there is more growth in the long term. Real estate provides you with higher return. Yeah. So that's, again, I understand that's a misconception, but I would like you to expound upon it as to real estate versus equity.
So I think two things make real estate a more favorable investment, psychologically speaking.
Okay.
So first psychological advantage in holding real estate is the physical asset. You can see it, you can hear it, you can rent it, you can sit on it. It's a physical asset. A financial instrument is an abstract asset. Correct. You can't see it, feel it, touch it. After DMAT, more so. So you can't feel it, touch it, there's no certificate.
So if I pass a lane, I'll see, okay, this flat is mine, I'm getting rent over here. Exactly. But I don't pass an ITC building and say, I'm
getting dividend from here. So that's the difference, right? Whereas ITC's dividend would be higher yield than the rental asset, rental income, right? But you won't probably see, you won't feel that way. So that's a psychological barrier that most investors have to cross.
Right.
That real estate, physical, so what, and that is abstract, so what. This is asset versus asset. Physical and abstract should not make a difference. So that's the first barrier. Second barrier, why real estate actually has created more compounded wealth in the past, is because you cannot churn it.
Right.
You cannot see quoted prices. So let's say a person buys a flat for 1 crore rupees. Next day the flat value falls to 90 lakhs. he's not going to panic and sell the flat.
And he doesn't even know it's fallen down to 90.
And he doesn't even come to know it's fallen down to 90, right? So he's not going to sell it also at 90. Even if he is aware, he's not going to sell it at 90 because it's a flat. You can't sell it on one day. But the same person buys a 1 crore rupee stock and the next day the stock is quoting at 90 lakhs. He might just panic and sell it.
Correct.
So lower liquidity, lower ability to churn also makes real estate a higher value compounder.
Because you're a default long-term investor by default.
By default.
Right.
Because of the structure.
And the volatility is not something that you can see.
Exactly.
So the actual volatility is very different and much higher as compared to the perceived volatility that you get from this asset.
So the problem with financial assets is that you can see the volatility.
Correct.
And that induces action.
Yes.
And because it induces action, you act. And because you act, you don't hold for a long term. And because you don't hold for a long term, it's difficult to make money in financial markets. So that brings me to the point where I strongly recommend to control your own behavior. Okay, stock prices and economy are different things. Focus on the economy, focus on the evolution of the businesses. Don't focus on stock prices. I give an example often on this front. Stock prices are like a dog and the economy is like a man. The man has the dog on a leash. If the man in 10 years goes from point A to point B, stock prices will go from point A to point B. But in between, the dog will go around here, jump there, bark, sleep, poo. He'll do all those things. The man will still continue walking. Correct. So if you are focused on the dog, which 99% of the investors are focused on the dog. Aaj market ka kya hua, right? 99% investors. So if they are focused on the dog, you'll always be confused because he's going to jump here, jump there, run ahead, run back, and you will not know where the dog is going. But if you're focused on the man who's just walking on a straight line from point A to point B, it's far easier to comprehend what's happening, right? So I think majority of investors make this mistake, far too focused on the dog than focused on the man. And our job as asset managers is to focus on the man and tell you what the man is, where the man is going to be in 10 years. And therefore we seek money that you invest with us. We are focused on the man. Yes, the dog will do its own thing in between, but in 10 years the dog will be where the man is.
Very interesting way of looking at it.
Yeah, it's a very simple way of putting it, but there is a lot of noise in stock prices and asset prices. It's just that in stocks you can see the volatility. Every asset price is volatile. In stock prices you can see the volatility. In other assets sometimes you can't see it, and because you can't see it, you can't act on it.
So discipline and working on your biases being very educating yourself against these biases that one has.
Yeah. So we have a saying in fund management: not acting is a very strong act.
True.
So if you don't act for a very long time, it's very difficult to do. But if you are able to do it, it actually creates a very strong outcome. More often than not, if you were right to begin with.
Correct. The tax advantages, etc., aside with respect to the churning.
Absolutely.
Right.
There's a cost to churn which people don't appreciate. You pay the broker every time you churn. You delay your gratification every time you churn, because every time you're buying a 3-year story, and if I break the 3-year story in 1 year, it's again another 3 years. So rather you stick to your first 3-year story and wait for 3 years.
But people looking at Wolf of Wall Street, etc., just want too much excitement with the markets and end up losing money in that process.
Yeah, so there's another important saying I read somewhere. Investing is like watching grass grow.
Okay.
If you want excitement, go to Vegas.
Okay.
True. Yeah, if you're a true investor,
it's long term, it's growth,
it's slow, it's boring, it's tedious.
It's watering that.
Yeah. So it's very boring, to be honest. Investing is a very, very boring journey. But you should have a passion to do it if you want to. And if you're actually a true long-term investor, there's not much for you to do once you get to office every day, but to read and understand your investments better. And you have to take less actions on the portfolio, more actions on the reasons behind the actions.
But I personally find that even more exciting and peaceful at the same time. That reading continuously, knowing, and just observing, basically.
So if observing is exciting to you, then this is the kind of job you should be in, right? Most people don't feel excitement when they observe. They feel excitement when they act.
Okay.
Now this is a job where actions actually hurt you more than often than not.
Right.
So not doing some things that's very, very important. So not making mistakes is more important than making good calls. So that's the kind of job we are in.
Wonderful thought.